Today, folks, we're taking a look at 11 dividend-oriented ETFs for income investors. These are taking into consideration different sectors, different countries to build out a level of diversification for wealth preservation. So if you need to rely on income to pay your bills, this is how I would personally do it as a Canadian. These are the ETFs my parents focus on in their retirement. Now, my name is Kyle. I'm documenting a path to financial independence. I had hopes one day to retire early, and I really hope you join me on that journey. You'll hit that sub button. We were talking about these ETFs this morning in my Discord. If you want to support the channel, you can join that Discord at kylelivingston.com. Link is in the description below. And I understand that we are in a growth-oriented market, so yields have deteriorated. We're not seeing the higher 4 or 5% starting yields on some of these ETFs we once did. But at the end of this video, I'll share with you 2 ETFs that are cover call strategies that have higher starting yields you can use to kind of balance off your portfolio. So hit that like button, folks, and let's get right into it. We'll start with the obvious ones for the OGs that have been following the channel, and even within my accounts, VDY to la motherfriggin' die, the Vanguard FTSE Canadian High Dividend Yield Index that is absolutely crushed and now doesn't have the best starting yield. But I didn't necessarily buy this for just the income. I bought it because it's more concentrated in the financial sector in Canada that I figured would offer better growth, and sure enough, we were correct. And now the yield is below 3%. I'm still cost averaging into this ETF, but I recognize that it wasn't as attractive as it once was, but you're getting a lot of concentration here. So you're 60% financials, with Royal Bank and TD alone making up over 25%. So every dollar or quarter of that is going to 2 stocks. So do be aware of that. But you're also getting some energy stocks in here like Enbridge and Canadian Natural Resources, Manulife, a lot of great companies in here. However, if I really wanted stabilized income, a higher starting yield, I would lean into its brother, another favorite in the Canadian economy, which is XEI, which is the iShares S&P TSX Composite High Dividend Index ETF. And God, whew, baby, these are going to be a mouthful of words. It's like a word salad trying to say the name of these ETFs. This one's also done exceptionally well. It has a much higher starting yield. Well, not terribly much higher, but 3.44% is a lot better than VDY's right now. And if you scroll down, you'll notice not one stock makes up more than 5% of the holdings, which is incredible. So you're getting Royal Bank and TD is still some of the upper weighted stocks, but together they only make up 10% of the ETF. And you're getting a better diversity between these sectors like financial and energy and utilities in here that are 13%. So for a level of wealth preservation and income-oriented investing, this would be my go-to. Now, let's talk about one sector-focused ETF that if we go into a bit of a dip and you get some opportunities, I would look at the Globex Equal Weight Canadian Bank Index, HBNK. Now, like Pokemon cards, I really believe you need to collect them all, and you will collect them all buying XEI or VDY. It's just a matter of how concentrated you want to be in these banks, and they are world renowned. They're the most resilient companies literally in the world. When the 2008 financial crisis happened, Greece was going broke. There was global crises around the world because of what that did to the financial sector, yet the Canadian banks rode through it no problem. In fact, we were supposed to be going into a mortgage crisis, and analysts were predicting the worst because of the higher interest rate environment. But because of the stipulations and regulations around handing out mortgages, the banks did just fine and now have crushed it to new all-time highs. The yield, again, at 2.64% is not as attractive as it once was, but if there are big dips in the economy, you want a sector-focused ETF for growth in Canada, this would be my go-to, and it has some of the lowest fees as well, but the returns here have just been insane. The Canadian bank sector has just been unreal. So let's pivot a little bit. If you are looking for income, you can't just focus on the Canadian economy because you're going to detriment potential long-term returns, and you're going to put yourself at a higher risk if something does happen to Canada, like a mortgage crisis, because again, nobody knows if this stuff actually happens or not. But I love SCHD. Let's pivot to the US just a little bit. And if you're a bit younger and getting close to retirement, you could buy this within your registered retirement savings plan, and it'll waive that mysterious over-the-border withholding tax, which somehow we have a treaty between our two countries that waives that 15% withholding just in the tax-sheltered registered retirement savings plan. However, like my parents that don't have access to an RRSP anymore, I would have no problem just buying this in a TFSA. You do not want to be scared of paying tax if it's going to, prevent you. A lot of people get scared and it prevents them from getting better security and diversity in their accounts. So I wouldn't mind paying the 15% withholding tax so long as you don't have to pay any personal income tax on it. So this is still a great ETF, I think, for one's TFSA. It's a very pronounced US dividend ETF that has a a very low expense ratio, 0.06%. But if we scroll down, the yield is at 3.3% right now, which is great to see. I mean, it's a nice starting yield. And if we look at the holdings in here, nothing makes up more than 5%. And again, we're getting exposure to sectors that are continuing to diversify us away from oil and financials. Because you got to remember, in Canada, there's a lot of oil companies, a lot of financial companies, right? So this one is giving you more healthcare and more consumer staples, things like Home Depot, Amgen, there's Coca-Cola, Procter and Gamble that makes like toilet paper products. And you can see you're getting 20% healthcare and 20% consumer staples with about 14% energy, 10% industrials. So you're starting to look at different ETFs that offer different sector exposure. Now, the other one I would kind of lean into is the Vanguard High Dividend Yield Index. VYM is the ticker for this guy. And this one's also done quite well this year, up 14%, not quite as well as SCHD, but this would be my second runner up. And I like this one a lot. The yield is a little bit lower at 2.22%. That usually gears people away from buying this one. But if you scroll down and you take a look at what you're buying here, you're getting a lot of good sector diversity here as well. Financial still a bit of an upper weighting at 20%, but otherwise you're getting a pretty even spread between industrials. You're getting some tech companies in here you're not getting in these other ETFs like Broadcom. You got JP Morgan, Johnson & Johnson, Caterpillar, AbbVie. So this is another great dividend ETF, and I know a lot of people are shunning away from 2%, but again, you want to make sure you're still leaning into growth. I look at these ETFs as a total return option because at the end of the day, total returns are your end result. And just because you're getting a high yield, you know, if the stock is yielding 3%, but the growth of that stock is basically mute, it doesn't do anything, then your total return is 3%. And that isn't something you want in your retirement. So what I would do as well is look at the other sectors here we're not getting exposure to continue that level of diversity. And these are the two sectors I would focus on in the US right now, being VPU, the Vanguard Utility Index, because utilities are the most underweight sector amongst many of these ETFs, and even broad-based S&P 500 ETFs, and even broad-based Canadian ETFs. And I would also look at VNQ, the Vanguard Real Estate Index ETF. So let's start with VPU, the utility ETF, which hasn't done that well this year, but I like it because we're starting to see extended growth in these companies thanks to, you know, EVs, data centers. Like, there's a huge level of demand for power, and this ETF just hasn't seen the same growth that the other, you know, sectors have. And I think there's good potential here, especially when interest rate cuts come into play. The US still has really high interest rates that I imagine over time will continue to come down, and every percentage point they drop is going to put a lot of extra bottom line returns to these infrastructure oriented companies because they just have a lot of debt. So the starting yield is 2.71%. And yeah, again, it's not the most exciting ETF, but it is incredibly stable with things like Southern Company, Duke Energy, giving you renewables and nuclear power. And if you zoom out and look at the long chart here, like, you'll see it's very boring and consistent. And that's what we want in our retirement. Similar to VNQ, the real estate ETF, right? It doesn't really go up that much. It's been more or less a flatlining stock, but I'm confident that, again, as interest rates come down, real estate will recover and offer better returns. And if we scroll down, we don't really see the yield here for some reason on Vanguard, but if we just take a look at Yahoo Finance, we will see the starting yield is 3.5%, and that is a great yield to start with for somebody in retirement. So there you have it. You have your, you know, broad-based ETFs in the US, and then you have your sector focus, just like we did with Canada. Now let's move into the international markets, and I got two ETFs here for you. One that you guys are familiar with being VIDY, the Vanguard FTSE Developed X North American High Dividend Yield Index. And what another mouthful. It's like word salad trying to get these things out. And this one's also done exceptionally well recently, and I love these ETFs for further offering diversity into other countries. Starting yield on this one is 2.83%. And if we scroll down just to get an idea of what we're buying here, we're going to see that the sector diversity across, you know, all these different countries like United Kingdom, Switzerland is a great place to start. Hong Kong's in here, Germany. So we're getting into countries most people don't own any stocks in, and you'll see, again, heavily financially focused. Unfortunately, in international markets, financials are a very big deal. They're huge aspects of major companies and market caps. So you'll see like HSBC Holdings is one of the largest holdings, but it doesn't make up any more than 2.6%, which is great to see. And then you got things like Nestle in here, Toyota Motor Corp's in here. Like, there's so many great companies that you get exposure to with this ETF. The second one that I would pick might be ZDI. This is the BMO International Dividend Series ETF. And if we just take a little bit of a deeper look here, this one has a slightly higher starting yield of 3.07%. But if we take a look at the holdings, they're not that far off. They're very similar, but you'll see they have ASML in here. So you're getting some exposure to the chip market again. And I actually like some of the holdings, the top holdings in this one, more than I do VIDY. It's just that this one has a higher starting expense ratio, but you're getting a little less financials at 28%. Industrials, healthcare's in here. So this one I think might be a little bit better for, income-oriented investors. The expense ratio is not beyond my limits. I usually don't like seeing them much higher than 0.5%. Comparably, what is VIDY's starting expense ratio is 0.32%. So you're not too far off, right? But those are the two international ETFs that I would lean in. Now, finally, if I just wanted to inch out some higher income and I just wanted to well round off my portfolio, again, I would not make covered call strategies a big portion of my accounts because we are in a growth market, and over long periods of time, even in retirement, you're not going to die in 5 years. It's likely you're going to live for another 20 or 30 years. You want to encapsulate the entire potential return. You want those capabilities because if you want to go on a nice trip, buy a car, do whatever, you want to do it potentially through capital gains because that is part of those total returns. But I wouldn't have a problem like leaning into these by 10 or 20% just to get that higher starting yield. But these are the ones that I would focus on that I know aren't that popular in the covered call realm of things. And if you take a look at the Harvest Canadian Dividend Leader Income ETF, I like this one. The ticker's HLIF. It kind of gives you a good, well-rounded performance of not writing covered calls on 100% of the ETF. And if we take a little bit of a look here, you'll see the starting yield sits at about 6.5%. It's not as extreme as some of the other ones out there, but I think it's a very nice, healthy starting position. And if we do go into a flat market or a market that starts to decline, at least you're going to be having a higher yield out of this that you can use to cost average or again continue to pay your bills, whatever works for you. And if you take a look at the portfolio, I do like the level of diversity that it does give us here, because you'll see financials are still a pretty big proponent along with energy, but you still got good utility exposure. And if you look at the top holdings, you're talking about, again, upper weighted stocks that, though are in similar sectors as these other Canadian ETFs, they are, basically ones that aren't upper weighted. So you're seeing things like Thomson Reuters, Suncor, Canadian Natural, Manulife, Nutrien, a Power Corporation. You'll see nothing makes up about the highest position is 4%. So I love the diversity. I love the different level of stocks that are upper weighted in this one. I like that the covered call strategy doesn't implement leverage. You got to be very careful. A lot of covered call strategies now are implementing leverage as an excuse to try and make up for the lack of total returns they offer, because naturally covered calls sell your potential upside, and we don't want that across our entire portfolio, because when we're in growth markets like this, we want to try and capture that upside. But regardless, I think this one does the best job of balancing options and growth. And my other one that I would pick for much higher income is SPYI. This is just focused on the S&P 500, and it's yielding right now about 12%, and it writes covered calls purely against the S&P 500. I think it's probably one of my more favorited ETFs for income investors because it's a good way to balance out your S&P in case we go into a flat market. Because for somebody like myself that owns VOO, if I wanted to lean into a bit of income, this might be one of the ETFs that I would pick for something like my RRSP. And it's not like overly complicated, but you do see the returns lag the S&P by a couple percentage points usually, just because, again, you're capping the upside and we are in quite a growth market right now. But I think this is a great ETF just to inch out an extra percent a month off the S&P that you could pair with your other ETFs. And again, these are the ones some of these my parents focus on in their accounts. And again, they've had such good long-term performance. A lot of these ETFs have good track records that have been around for a while. And again, this is something you're gonna have to figure out how you would balance, because there's different tax structures behind this. For my parents, as an example, that don't have RRSPs, we focus more their dividend, US dividend stocks or ETFs in their TFSA, because yes, they're going to pay the withholding tax, but fortunately, Canadian dividends are much more tax efficient, even in a regular brokerage account, because they're qualified dividends. So if you have no other income, I think you'll find you're better balanced orienting your international and US ETFs more in the tax sheltered accounts, and your more qualified dividend ETFs outside, because they're already, tax efficient. So these are things you're going to have to figure out how to balance. How much Canadian do you want? How much US? How much international do you want? Those are all questions you can take into consideration that if you'd like to talk more deeper on, again, book a one-on-one, kylelivingston.com, join the Discord. I'd love to hear more about what ETFs you love as well in that comment section below. But as always, I look forward to catching you in the next one.